So today's topic is, are you worried about tax and estate planning benefits? And in the whole context of investment still, I think the next quote from Susie Orman, which I admire as one of the financial planners of the world, that has done quite well for herself, says, it may take you months or even years, a few years, to build up an adequate emergency savings fund. That's okay. So, yeah, we're not only talking about emergency funds today, but we're talking about building up investments. And today I'm going to talk about an investment vehicle that I think is suitable for a lot of us as on this presentation today. So the current situation or current position for many people is that you might be looking at your investments and you think, wow, if I had to sell out now, I'll be paying a lot of income tax or capital gains tax and things like that. So that's on the one side of the coin. The other side of the coin is that, gee, what's happening about my estate planning? If I die today, obviously it goes into the state, and I might be paying, there'll be a lot of tax on that side. So what can we do? So the ideal situation is to be in a situation where you're more tax efficient, and I'll be talking about it just now. We're ticking all the boxes. We're not paying, we're not avoiding tax. We're just becoming more tax efficient, and that's one side of the coin. And obviously, the other side of the coin, we have a happy family. There's a legacy. You're leaving a happy legacy. So that's where we talk about estate planning. So I think a lot of us on this presentation would like to be in that situation. Just before going on, is it okay with the webcam? It's not buffering or anything like that. Okay, looks okay. Okay. So what am I proposing? How do we get there? So today we're talking about investing in endowments. So a PSG endowment is a type of investment product. It's ideal, what I call a long-term savings vehicle. So it gives you, as an investor, full access to your money, but there are restrictions. There are restrictions. There's a 5-year period. So you're locked in for 5 years. There are obviously some leeway with regard to taking that money out. But when I say a long-term savings vehicle, I understand it's a 5-year period that you're looking into. But the main thing is that you can use this endowment as a vehicle to reduce your tax payable on the investment growth. And it's ideal for investors who pay income tax of more than 30%. If you're on a marginal tax rate of more than 30%, this is the ideal vehicle for you. That's number one, the individual. Secondly, for those people that have family trusts, I have a family trust, this is also a very good vehicle, especially obviously the beneficiaries are natural persons. We'll talk about it a bit later. Okay, so as I said now, it's ideal for investors with a high marginal tax rate, more than 30%. But also, I want to clarify something. When I say tax efficient, it doesn't mean that it's tax free. It's important to understand that tax efficient means it's determined by a degree to which the returns on the investment are reduced, okay, as a result of tax. Okay, so regardless who's paying the tax, be it an individual, company, or a trust, okay. So bottom line, when we talk about tax efficient, the less tax, the more tax efficient. Okay, so let's go into more detail. So endowment tax, how are endowments taxed? They talk about the 4-fund approach. They refer to this 4-fund approach, but it's actually a 5-fund approach now after the latest budget. So it's based on what they call the Section 29A of the Income Tax Act, and that determines the income tax taxable, taxable income of the life insurer. Okay, so the life insurer must establish and maintain 5 funds. So PSG obviously will house the endowments within a life fund. So the returns in each fund are taxed at different rates. This is how this 5-fund approach would work. So the life insurance assets must be divided as follows. We talk about the individual policy fund, the company policy fund, the untaxed policy fund, the corporate fund, and then what they introduced now recently was the risk policy holder fund. So we talk about the individual policy fund. This is obviously for individuals, natural persons, and trust if the beneficiaries are natural persons. Number one. Number two, the company policy fund, we refer to a company, a PTY, or the old CC, the company, what the word now, CC, a closed corporation. Okay. And then obviously we got things what they call tax exempt entities. There's a whole lot of them. But obviously, because of time constraints, I was not going to do all of the details. Remember, the presentation I'll be sending you, there's some hidden slides because of time constraints that I suggest you also go through and then tie it up maybe with the recordings. So when we talk about the tax rates on returns, and I want to highlight mainly because I presume most of us on this presentation today are more the individuals that a company or representing a company or a trust. So the marginal tax rate on interest earned is 30%. Now the inclusion rate was 33 and a third percent for individual policies holders. Before the latest budget, they bumped us up. Now remember, the government is looking for additional revenue, but anyway, the inclusion rate has been bumped up from 33 and a third percent to 40%. Now 40% of 30% works out to effective tax rate for capital gains tax of 12%. Okay, remember in the past it was roughly about 10%. Now been bumped up a bit higher. In the company's hand, remember, a company pays a 28% tax, and that's been bumped up from 66.6% up to 80%. So the effective tax rate for a company is 22.4%. What's interesting to note from the last budget, interest is exempt in the funds, okay, as well as capital gains. And you'll see in the next slide what I mean by that. So here's a quote from Will Rogers, and I say things change when he refers to the Congress. We can talk about South African budget. The only difference between debt and taxes is that debt doesn't get worse every time Congress meets or every time we have a budget speech. Okay, that's just for I throw that in to make it a bit more lighter. So let's talk about tax benefits for individuals. So a natural person, we've got a marginal tax rate between 18 and 41%. So 40% on that, the most you'll be paying on effective tax rate is 16.4% if you're on a 41% tax rate. We're still paying 15% dividend withholding tax. In your hands, okay, as individuals, still have interest, the exemption from between 23,800 to 34,500, as well as capital gains tax. Or capital gains rather, 40,000. The first 40,000 of gains is exempt. That's in your hands. But in the fund, you'll see there's no exclusions. Okay, so that means the tax saving to individuals who have marginal tax rate higher than 30% and who have exhausted the interest exemption and the capital gains exclusion would benefit from these endowments. So remember, there's no income tax benefit to individuals with a marginal tax rate of 30% or less. Okay, so when it comes to the fund, okay, we talk about the fund. You as a member of that fund would be paying 12%. Okay. Here's an example. As I say, going back to the previous slide, I have hidden the tax benefits for companies and I have hidden the tax benefits for trust because of time constraints. So here's an example of how this would work. If you had to go buy a unit trust as an individual or within an endowment, you'll see the tax benefit. So here we have the Bill Buffett Trust that invests $1 million in PSG Wealth Creator Funds of Funds. Okay, the beneficiaries of the trust are the founder, which is Bill, his wife Melinda, and their 2 children. The value of the investment after 10 years was $3 million. So we're making capital gain of $2 million. The funds are withdrawn by the trust. So as an example of, let me just get my little thing here. My spotlight. So if it was a normal investment fund, okay, so let me just get out the way here. The webcam is bounced up and I don't know how to get rid of it. It's in my way. Okay. Here we go. Sorry about that. So the investment was $1 million. So the same scenario in both cases. Interest earned is exempt. Okay, so capital gains is $2 million in both situations. But look what happens now from a tax point of view. Within as an individual CGT payable, the effective tax rate. Remember, this is as a company. Okay. 41%. The exclusion rate is 80% on 41%, so they're paying 32% in the trust hands and 12% within the endowment. So in this scenario, 2 million times the effective tax rate, you're going to pay 656,000 rand. So your net investment after tax is 2,344 rand. Look at the scenario with within the fund. Okay, you're only paying 12%. 240,000 Rand, look what you get out, much more. So it's a big impact, big difference. Okay, so that's what I wanted to highlight as an example. So that's the tax. Let's talk about, there are certain restrictions, certain limitations. There's a 5-year period we spoke just now. You have access to that fund, okay? But during this fund, you have access to your investment. There are limitations in place, as I say. You can access the investment at any time after the 5-year period. So there's no restrictions after the 5-year period. Within the 5-year period, you can have one loan. So during the initial restriction period, you can make one loan from your investment without being charged interest. That's one tax-free investment, number one. Or rather, you can also make a withdrawal without having to pay it back. So as long as the value of your withdrawal is not more than the money you've invested, plus 5% compounded growth per year. And I think the best way to explain this is in the next slide. So how do you access your funds? In the first year, you invest 200,000. The next year, you invest another 100,000. In your third year, you invest 240,000. So we talk about this, what they call the rule, the 120% rule. I'll go into more detail in the next slide. So 120% works out to the higher of the value. So on the 200,000, which is the higher of year one and year two. So 200,000, 120% of that. So year three, obviously you can. That's how we got to the 240,000 Rand. Okay. So after year three, we decided, okay, we want to buy a house. We need a deposit on the house. We've contributed 540,000 Rand. So you got two choices. You can either withdraw the 540,000 Rand plus 5% as a once-off withdrawal. Okay, or you can loan 80% of the 540,000. In other words, take out 432,000. Obviously, the other funds will stay behind, but after year 5, you can withdraw all of it, no problem. Okay, so those are what I'm proposing, how the endowment would work. What are the benefits? First of all, I see there's 6 benefits. First of all, as I say, it's a disciplined way of saving. So you might have a debit order, you might put it in lump sums. We'll talk about that in the next slide, a few slides. But it offers you a disciplined approach to saving. That's number one. Number two, as I mentioned already, it's very tax efficient. You only pay tax that's applicable on your behalf. And obviously, for investors with a higher marginal rate, more than 30%, this is an ideal vehicle for you. It's also ideal for estate planning, and I'll touch on it a bit later. So you can structure your estate in a more tax-efficient manner. So those are the 3 main benefits, but also going further, within your endowments, you have access to a range of investment funds to choose from. You can choose from over 400 funds on our platform. And by the way, if you click on that, it'll highlight the list of funds for you, take you through to the list you can choose from. And then secondly, what's also important to understand using PSG platform, you can switch between these funds at no extra cost. And by the way, if you click on that link, it'll highlight for you what we call funds A to Z. It helps you choose what funds to go through. But also remember, with PSG funds, our funds are from a fees point of view, are much lower compared to everybody else. So that's something you really want to consider, because fees over the long term does have a big impact. We have discussed that in other webinars. The fifth benefit, I think, is that you, from a contribution point of view, you can make a regular monthly contribution via debit order, or you can add lump sum contributions at the start of your investment or any time during that time period. Or you can make a combination of the two. Just remember that rule of 120% rule, okay, compared to the next year. And I'll go into more detail a bit later regarding that 120% rule. And then obviously also important is flexibility. Okay, you can suspend your monthly contributions, your debit order, should you experience any financial difficulty. So there's no time period when to start again and things like that. But try and resume making contributions as soon as possible. Just to be aware, if it's more than 2 years, we start another 5-year period. So endowments are ideal for lump sum investments, if I put it that way. Okay, so you guys might have a lot of questions. So one of the questions will be, what are the contributions? As I say, initial lump sum, that's a minimum of 20,000 Rand. Okay, and obviously they're on top of any additional lump sums allowed thereafter. A regular debit order investment of at least 500 Rand monthly or combination of the above, just to say the 120% rule applies. Now, some of you might be wondering, what is this 120% rule? So what it means is during your first year, you can make unlimited ad hoc contributions. That's in your first year. In your second year, you can make additional investments up to 120% of the total amount you invested in the first year. Okay? After the second year, your contributions may not be more than 100% of the highest contribution made in the previous 2 years. So here's an example. So in my first year, I contributed 200,000. My second year, I contributed 100,000. How does it would work? So it's 120% of the 200,000, okay, which is 240. 120% of that. So my third year, I can contribute the maximum of 240,000, which is 100% of the 120% of the highest of the previous 2 years. Okay. If it exceeds that, if a contribution exceeds that investment amount, obviously you enter a new 5-year period. So just be aware of that kind of limitations. So let's say you as an investor adds 50,000 Rand in your third year. Okay. What can you add in year 4? So remember, in year 2, we had 100,000 times 120% rule, which is 120,000 Rand. Okay. So in year 3, I had 50,000 times my 120%, which is 60,000. Therefore, I can invest, remember, the higher value, which is 120,000 Rand in my 4th year. So just be aware of those kind of calculations regarding your investments in the next years and things like that. The other question that some of you might be worried about is, can I lose money? What are the risks? The value of your investment, remember, is linked to market value of underlying instruments and underlying unit trust that you choose. So obviously the market goes up and down. So your investment return is not guaranteed. Just be aware that's number one. So it's very important that you ensure that you're comfortable with the level of investment risk. Okay, that's number one. Okay, number 2, the endowment is not protected against claims from creditors. Okay, that's number 1. And number 2, obviously, it's also not protected from your ex-spouse if you get divorced. So those are some of the things you also must take in consideration regarding the risk. So we mentioned just now about estate duty. What's nice about this, especially from a trust point of view, trust can take out what they call a sinking fund policy. All it is an endowment of no life assured. So all it is what the benefit helps with. The policy continues into perpetuity, carries on forever. It will not be effective years the policyholder dies or the death of anybody else. So it carries on and on and on. So that's nice about the estate planning. Remember, it goes into it's form part of your estate, but it won't be taxed and things like that. So there's another quote from Susie Orman. Estate planning is important and the everlasting gift you can give your family. And setting up a smooth inheritance is as hard as you might think. So we did this all for you. Okay, so that's one nice thing about it. So let's tackle what questions you guys might have. Okay, you're cutting. Okay, it must be my webcam. I'm going to cut this off. Guys, come type in the question box what questions you might have. Can you guys still hear me? Gone very quiet. Yeah. Paul, there's a question from Paul. Thanks, Paul, for the question. I have 1 million. I'm looking to invest in absolute fixed deposit. Endowments does not have a minimum rate of return. There's no minimum rate of return because remember, Paul, you're choosing unit trusts. So the market equity linked to unit trust will always outperform a fixed deposit. So I'm not 100% sure about your question. Charles, thanks. Yes, you can hear me clear. I great appreciate that. Paul, I hope that answers your question. Endowments does not have a minimum rate of return. No, there's no minimum rate of return. But there's also no, maybe it's minimum investment. There's no minimum investments. You can put as much as you want to into your endowment. Just understand that this is not for someone who wants to get the access to the funds in the short term. So, fixed deposit might be 90 days, wherever the case might be. Those things you have to take into consideration. This is more of if you had to look at a long-term investment. 5 years. Okay. So Paul answers back 5 years. Yeah. So yeah, it's be better vehicle for you if you're looking at it that way. And it's also tax efficient. Okay. Are there any other questions? Okay, Benjamin, you also have a nice day. As a question from Biani, is this only ideal for married individuals? This is only ideal for married individuals. It's for individuals, for trusts, for companies. Okay, it's ideal for someone that's paying more than 30% tax. Biani, I hope that makes more sense. So if you, it doesn't matter if you're a married couple, maybe it's individuals, maybe as a household, you might want to have an endowment. But it's ideal for someone paying more than 30% marginal tax. The threshold of income. Not 100% sure what you mean by that. What are the good question here from Trevor Island? What are the benefits versus a tax-free savings account? Get my head back to tax-free. Well, the big benefits of there's no limitations. Remember, with tax-free, you can only put in 30,000 Rand a year, maximum of 500,000. Yeah, there's no limitations. I mean, you put in per year. Obviously, still taking consideration that 120% rule. So you can put in R1 million every year if you want to, Trevor. That's number one. And ideally, also, the advantages with tax-free is that your interest, your capital gains, your dividend withholding tax is exempt from tax. That's a growth. Whereas works on your exclusion rate and works on your marginal tax rate. So there's pros and cons, Trevor, if I had to answer that. But I think the big benefit with regards to endowments over tax-free is that there's no minimum investment. Okay. I hope that answers your question, Trevor. Are there any other questions? You guys are typing. Okay. Okay. Good question, Trevor. Thank you. Okay, while we're waiting for more questions to come up, let's just wrap it up quickly. So what I want you guys to remember from this presentation, endowments are tax-efficient investment vehicles. So remember also from estate duty, it continues in perpetuity. And remember the underlying funds, you have over 400 funds to choose from. And obviously PSG funds have been performing very well. So maybe consider those also. Remember, they perform well and obviously the costs are much lower. So what are the next step? If you click on that link there, if you're interested in opening up an endowment, there's links to get the process going. As I mentioned before, the webinar and the recording will be sent out tomorrow. So if you've got any queries, you're welcome to contact us. There's the client services email and there's the switchboard, etc. So upcoming our webinars, and next week I'm on leave. I'm down in Umdloti on holiday. So the week after that, we got the people from Grindrod Core Shares, and their topic is why you should have exposure to property ETFs right now. It's quite interesting. It's quite topical. 6th of April, we're talking about investment opportunities outside South Africa, so offshore investing. And so for middle of April, we're looking at 5 pros and cons about investing and trading. So a bit of comparison, and we look at different vehicles to get there. Okay. So guys, I hope you've enjoyed it. Let me see if any of the questions, if any more questions you guys are coming up here with. Paul, another question from Paul. Do you have an idea of the average growth rate of the 400 funds on average? Paul, not 100% sure. Out of the 400 funds, I would say about usually about 25% of them outperform the benchmark. Benchmark would be the Aussie 40. Difficult one. I suggest you go through that funds A to Z list. You can also go to that little tool we use and then chomp down and go look at each different sector. What are the general funds, and look at the performances over there over the last 6 months, year to 3 years, 5 years, 10 years, etc. So, yeah, I can't really answer your question, but it looks like you have my answer. Thanks, Paul. Thanks for the questions anyway. Looks like those are all the questions, guys. Okay. But Paul, thanks a lot for your questions, and same to Trevor and Vianney, and thanks for participating. So, guys, from my side, I hope you've enjoyed it. Until 2 weeks' time, enjoy the rest of your week, and from my side, have happy holidays. Okay, bye for now.